In this video, I'll share with you the framework that I believe will help you before you invest in the stock market. So if you want to achieve anything in life, you need to have frameworks. So if you want to be successful investing in the stock market, if you want to be healthy, or you just want to achieve success in the general sense of the word, you need to have frameworks. For example, if you want to be healthy, there is a framework. You need to have 2 steps, right? So the 2 steps in the framework is eat healthy, and the second step is exercise regularly. Sure, there are different strategies to eat healthy. For example, the keto diet or the paleo diet and so on, right? And there are also different strategies for exercising. For example, using your own body weight or using weighted exercises and so on. But all these different strategies still tie back to the framework, which is eat healthy and exercise regularly. So similarly, to invest successfully in the stock market, you need to have frameworks. And I'll share with you one of these frameworks in this video. The first step in the framework is price versus value. When I finally understand and implemented this step in the framework when I first started out investing in the stock market, everything clicked for me. To explain what price versus value means, let me give you an example. So we have a picture of a coffee in front of us, right? So what do you think is the value of the coffee? It might be $1.50, it might be $2, it might be even $10. Right? But let's say we take the average value of the coffee to be $5, okay? Then let's take a look at another picture. What do you think the average value of the house is? It's definitely going to cost us a couple of $1,000s, right? In fact, it might even cost tens of thousands of dollars or even hundreds of thousands of dollars, right? So that is the value of the house. So how does this relate back to price versus value, right? Let's find out. Let's say you have $1,000 right now, and a person approaches you to sell you a coffee and a house. And the catch is, the coffee and the house both cost you $1,000. So the person is selling you the coffee at $1,000 and a house at $1,000. So which one will you buy? You will buy the house, right? $1,000 for the price of a coffee is relatively greater than the value of the coffee, right? Because we have already determined the average value of the coffee to be around $5. So $1,000 is relatively greater than the value of the coffee, which is $5. So that makes the coffee expensive, right? Because we are paying $1,000 for a $5 value coffee. And the same $1,000 is considered cheap for a house. So why is $1,000 cheap for a house? Because the price that we are paying for the house is $1,000, right? But the $1,000 is relatively lower than the value of the house, which is at least a couple of thousands of dollars, or if not hundreds of thousands of dollars. So the point I'm trying to make here is we should not take a look at just the price by itself. We need to take a look at the price in relation to its value. $1,000 is expensive for a cup of coffee, but that same exact $1,000 is considered cheap for a house because we are taking a look at the price versus its value. The same thing is true for stocks, right? Especially if you're a beginner in the stock market. And this is certainly true for me when I first started out investing in the stock market. When I first started out investing in the stock market, when I look at a stock which costs $10, the first thing that comes into mind is this stock is cheap. And again, why is it cheap? Because I'm just looking at the price of the stock itself. So a $10 stock would be cheap for me. And in contrast, when I look at a stock such as Amazon, which now is above $2,000, I would think that the stock is expensive just based on its price. And this is a common misconception that investors have in the stock market, right? They just look solely at the price of the stock without considering the value of the stock. So using the example earlier on, let's say we take a look at a $10 stock. The price of the stock right now is $10. But let's say we did our research either through the discounted cash flow method, P ratio, PG ratio, and so on, and we have determined the value of the stock to be $1. Is the stock now considered cheap or expensive? It is expensive, right? Because now we are taking a look not only at the price but also the value. So the price right now for the stock is $10, right? But we have determined the value of the stock to be $1. So the price in relation to the value makes the stock now expensive, right? It's no longer about $10. It is $10 in relation to $1. So that $10 is now expensive. So similarly, if we take a look at a stock such as Amazon, so right now, let's say the price of Amazon is around $2,000, right? But let's say we did our research and our analysis and we have determined the value of Amazon to be closer to $3,000. Is the $2,000 now considered cheap or expensive? It is considered cheap, right? So again, why is it cheap? Because now we are taking a look not only at the price, but we're also taking a look at the value. So the price, which is $2,000, in relation to the value, which is $3,000, make the stock cheap. Because right now, $3,000 is more than $2,000, right? So that makes the stock cheap. So the first step is to look at the price versus the value. We should not look at solely the price, but we should look at the price in relation to the value, right? So that's the first step in the framework. So the second step in the framework is to invest in leading companies in up and coming sectors and industries. This might seem like common sense to you and I, but there are so many investors out there who choose to ignore this step and still invest in companies in declining sectors and industries. So let's take a look at an example. So which will you invest in right now? Will you invest in companies in the airlines industry, or will you invest in companies in the technology sector? So with everything that's going on right now and the demand for air travel falling and declining, the airline industry is going to take a hit. But at the same time, tech companies are doing better than ever, and they are expected to continue to do better in the future. Right? So this is the Wall Street Journal. So the Wall Street Journal mentions that Facebook usage soars, right? So the tech giant says total messaging across the platform's services has increased by 50%. That's for Facebook. And for Microsoft, 775% increase in cloud services, 44 million daily Teams users, 900 million meeting minutes weekly. This is for Amazon. So Amazon was already powerful. The pandemic cleared the way to dominance, right? The global health crisis has forced 250,000 US stores to close, clearing the way to Amazon's dominance. So these companies which utilize and leverage on technology are doing better than ever during this period, right? And on the other hand, the future is not so bright for airline companies. So Warren Buffett mentioned in Berkshire Hathaway's annual shareholder meeting on the 2nd of May that he sold all his positions in the airline companies, right? Some of the airline companies that he owned are Delta Airlines, American Airlines, Southwest Airlines, and United Airlines. And he sold all of his positions in those companies. So he did not just sold a portion of his positions in these airline companies. He sold all his positions in the airline companies, right? And he commented that we will not fund a company where we think that it is going to chew up money in the future. So Warren Buffett, famous for his long-term outlook on stocks and the stock market, believes that the future for these airline companies are not bright. Now that we have taken a look at some articles, let's take a look at actual numbers and figures to see how tech companies has performed relative to this airline company. So this is the performance for the sectors in the past 1 month and past 3 months. Past 1 month performance for the technology sector has been 15.8% on average, and the past 1 month performance for the industrials has been 11.2% on average. And if we go back even further, 3 months performance, we see that technology has declined by 7.2%, but the industrials have declined by 23.3%. So these are actual numbers and figures which shows the performance of companies in the technology sector versus companies in the industrial sectors. So the second step in the framework is to invest in leading companies in the up and coming sectors and industries. Because if we invest in leading companies in up and coming industries and sectors, these companies will tend to perform better than companies in declining sectors and industries, right? So that is the second step in the framework. The third step in the framework is knowing your investing time frame. Your investing time frame will also influence your investing decision, right? For example, an investor with an investing time frame of 1 year versus an investor with an investing time frame from 2 to 3 years might invest in different companies, right? So using the same example that I mentioned earlier on about airline companies, so if you're an investor whose investing time frame is 1 year, you're unlikely to want to invest in airline companies right now, because right now the next 1 year for airline companies are not going to be very optimistic and bright, right? On the other hand, if you're an investor who has an investing time frame of 2 to 3 years or more, then the situation might be different from you and your investing decision might be different. So let's take a look at this article. So this article by CNBC mentioned that Delta CEO Ed Bastian, hopefully I'm pronouncing his name right, last month said that it would likely take 2 or 3 years for air travel demand to recover. And this is a forecast shared by Boeing's CEO, right? So air travel is only expected to pick up 2 to 3 years from now. And this is a sentiment held by the airline companies themselves. So if you are an investor whose investing time frame is 1 year, it is unlikely that you want to invest in airline companies right now, because right now the 1 year time frame for airline companies doesn't look too good. On the other hand, if you are an investor whose investing time frame is 2 to 3 years or even more, then the decision to invest in these companies might be different from you, right? So the important point to take note is your investing time frame, right? So that is the third step in the framework. So these are the 3 steps in my investing framework. I believe that this framework will better guide your investing decision in the stock market. So if you are taking a look at a stock and deciding whether to invest in the stock or not, you can use this investing framework. So the first thing we'll take a look is whether the stock is cheap or expensive. And remember, we do not want to solely look at the price of the stock. We want to determine its value and then compare the value to the price of the stock and see from there whether it's expensive or cheap, right? Then the next thing is we only want to invest in companies that are in up and coming sectors and industry. So if the company is in declining sector and industry, it's very likely that the stock price of that company will also decline, right? So we only want to invest in leading companies in up and coming sectors and industry. And then the third step is knowing your investing time frame. Once you are aware of your investing time frame, it will help you make better investing decisions. Hopefully you guys have learned something in this video. If you have learned something in this video, make sure you smash that like button because it will help the channel grow. If you want to watch more videos such as this, make sure you subscribe to my channel because each week I release one new video about investing, trading, and the stock market. I'll see you in those other videos. To your financial success.